This is Nick Reese here with an update on the U.S. business cycle. So here we have the U.S. leading economic indicators year-over-year rate of change. That's ticked higher from a prior reading of plus 6.2 to plus 6.4. So you can see here, history suggests that recession is unlikely to start within the next 6 months based on this indicator. Then looking at yield curve steepness, the 10-year yield minus the 3-year yield, that's at plus 30 basis points. That is still positive. It's been on a flattening trend for many years. What would get me negative is to see this yield curve invert, meaning the 3-year yield becomes higher than the 10-year yield. And if this trend is any indication, that could happen as soon as later this year. So we'll keep an eye on that. Then the U.S. PMIs, the Purchasing Managers Index, the manufacturing PMI just came out. That ticked higher from 57.3 to 58.7. So that's holding up near the high end of the multi-decade range here. What would get me negative is to see that manufacturing PMI number go below 50. In terms of the global growth backdrop, represented here by the manufacturing PMIs from the largest 12 economies in the world, we continue to see a deceleration. Most of them are still above 50, but we do see Russia ticking below 50 here at 49.8. And in general, there's this kind of deceleration that's been happening over the past few months. So the levels are actually still relatively positive with almost all of them above 50, but the trend certainly looks negative, and so that's worth keeping an eye on. In terms of the U.S. labor market, here we have the U.S. unemployment momentum, which just shows the U3 unemployment reading, which just came out at 3.8. That ticked down from 3.9, just released in last Friday's jobs report, and that's below the 12-month moving average, which is the gray line here. What would get me negative is seeing that U3 move above its 12-month moving average. Then this gray line is the San Francisco Fed model for the U3 index. It's a leading indicator of the U3 rate, or that's what it's designed to be. So not showing any signs of a higher trending U3 here. We generally see this continuing to trend lower, which is generally a positive sign. Then the U.S. labor market capacity utilization. So this takes the CBO's estimate of the natural rate of unemployment minus the actual rate. And because the actual rate is at 3.8% and below the estimate, you can see this this line is above zero. So you can see the green area there, and that historically has represented late cycle data, but there have been situations where that can persist for some period of time. So I would say I would get incrementally negative on this picture with sort of a 1 to 5 year outlook, roughly speaking, sort of a medium-term outlook, that this could mean that we are closer to the end than the beginning of the business cycle, which I don't think will come as a surprise to anyone. Then the Atlanta Fed GDP Now forecast, it's a really volatile series, but for what it's worth, the latest reading showing 4.8%. That's the theoretically that's the estimate for the Q2 GDP reading. I would suspect that that'll probably come down before the end of the quarter, but it could suggest that we're getting into that we might have a higher growth quarter for Q2. Then the U.S. household credit cycle. So we have an updated data point here. This is from the quarterly New York Federal Reserve Household Debt and Credit Survey, which is a very worthwhile report to flip through. But I think the key data point is represented here, which is the percentage of household debt that's delinquent. And so currently, that is continuing to trend lower. The 3-quarter moving average of the delinquency rate is 4.72%, which is below the 6-quarter moving average of 4.76%. They've basically been, these two lines have basically just been touching for the past few quarters, but let's see how that develops. I don't want to prejudge the data. The idea is that these are leading indicators, and we can track the data as they come out. But what would get me negative is seeing that 3-quarter moving average cross above the 6-quarter moving average. All right, then U.S. consumer confidence, so that continues to generally trend higher. You can see here for the Conference Board consumer confidence, that's the black line, that's generally at an elevated level, and I would be somewhat cautious on this, just given that at these levels it can act somewhat as a contrarian indicator, but we do tend to see both of these lines trending down ahead of recessions, and so what I would be looking for to get negative here is to see both of these lines trend lower on a year-over-year basis, which they're not doing yet. They're still trending higher for the time being. All right, then U.S. bank lending standards. This comes from the Federal Reserve's Senior Loan Officer Opinion Survey, basically surveying whether these banks are tightening or loosening lending standards. Generally, you can see they've been loosening lending standards, and that's all we can say about this. What would get me negative is seeing lending standards tighten. I've drawn this dotted line here at the 20% level, as that's kind of been the indicative level in the past two cycles of recession. But once you see a clear uptrend, I think that is worth paying attention to. We did see that here from basically 2013, 14, 15, 16, somewhat of an uptrend there. And then we've seen some easing, some regulation passed in recent weeks that might further lead to easing. Don't want to speculate on that too much, but in any case, no warning signs yet on this chart. Then the high yield spread, that's remained relatively contained, although it is right now close to the high end of the 1-year range at 3.51%. That's the spread of the high yield corporate bond yield over the 10-year U.S. Treasury yield. All right, so then in summary, to go through, the LEIs are still positive year over year. No signs of deterioration yet there. The yield curve is still positive. This gets a lot of attention in the media, but it is still positive, and I would expect, as a base case scenario, that this will become inverted before the next recession, and that will be the time to have concern about the yield curve. The U.S. PMI, so the manufacturing PMIs, are near 58, which is still a very elevated level. Global PMIs, I've marked this as neutral to positive. We do see some continued slowing momentum there around the world, and with the Russia PMI going negative. That's not as concerning as if it were Germany or Japan or China, but it is worth noting. Then the U3 versus the 12-month moving average, so that continues to be a positive picture, with the U3 trending lower and ticking down to 3.8 on the last report. The San Francisco Fed's model does not show that trend in the U3 rate is likely to change in the near future, so that continues to look positive. Labor force capacity utilization, that indicator I'm negative on over the medium term, given that it suggests that we might be operating above capacity. Now, that's an estimate from the CBO, and that condition can persist for some time, but I would say that does strongly suggest that we're getting towards the end of this business cycle. The GDP Now forecast, that's a very short-term indicator, but for what it's worth, that has ticked up and suggests that maybe the Q2 reading will be a strong one. Household credit, the household credit cycle continues to strengthen with the falling delinquency rate. The U.S. consumer, the consumer confidence indexes look good in the sense that they're both still trending higher, but we do see them at elevated levels, and that is a little bit of a cause for concern as a contrarian indicator. Then lending standards, they continue to be relatively loose. That, of course, can build up to some future problems, but for the time being, over the near term, as it regards the business cycle outlook, that appears to be a positive. The yield curve, the high yield spread, that remains contained and generally is still a positive. All right, so that sums up the update on the business cycle.